welcome back to the deep dives. So you've handed us a pretty intense stack of source material today.
I have.
It looks like it's focused entirely on what you might call the conceptual anchors for Canadian tax planning.
That's a great way to put it. It's all about precision. This is the stuff that, financial experts really build their careers on.
Right. So our job today is to kind of pull out those core insights and, I guess, stress test the common traps people fall into.
Exactly right. We're trying to move beyond that sort of conversational feel of taxes, how it feels, and get right into the foundational structure, how it's actually calculated.
And this material seems, well, it's almost forensic in its focus.
It is. It's very clinical. It demands these incredibly precise definitions and calculations, and it's really designed to punish any kind of casual approximation.
So if you miss one part of a three-part rule.
You've failed the conceptual test. It's that black and white.
Okay, so let's unpack this with some real rigor then. Our mission for you, the listener, is clarity. We want to move you from thinking about tax as just this thing that happens once a year to understanding it as a dynamic framework, one that's built on specific rules about rates, timing, and what the material calls deduction leverage.
That's it. The whole logic in these sources is anchored in three pillars that govern pretty much all smart tax decisions.
Okay, what are they?
First, understanding when income is legally recognized for tax. Second, grasping how a deduction actually works to reduce that income.
And the third?
And third, identifying the single most important metric for any kind of forward-looking planning, which is the marginal tax rate.
Right.
If you can master those three elements, you're on the gateway to some really sophisticated tax management.
The tone of these sources is also key here.
Yeah.
It feels like high-yield material. It assumes you already know the basics, and it just jumps straight to the places where, even professionals might fail. These little nuanced distinctions.
Exactly. And our goal here is to embed that required precision, but without the slow, painful slog of just memorizing rules.
Okay, so let's start where all true tax planning has to begin. The difference between the marginal tax rate, the MTR, and the average tax rate.
Yes.
Because the failure to know which rate to use for which decision seems like maybe the most costly mistake in personal finance.
It really is. Everything flows from this distinction.
So let's start with the MTR. The source material calls it the driving force behind all planning.
It is. And the definition is, like we said, very precise. The marginal tax rate is the tax rate applied to the next dollar of income you earn.
Not a broad average.
No, not at all. It's the instantaneous rate. It's the rate that applies at the absolute highest layer of your income.
And in Canada, that's a combination of federal and provincial brackets, right?
Exactly. It's your highest federal bracket plus your highest provincial bracket, all combined into one number.
Okay, so if a financial planner is looking at, say, whether you should take a $5,000 bonus this year or make an RRSP contribution.
Yeah.
They have to look only at the MTR. Why is that one rate so powerful?
Because it determines the real economic value of every single action you take at the margin.
At the margin.
If you earn one more dollar, that dollar is taxed at your MTR. But, and this is the crucial part, if you take a deduction, that deduction saves you tax at your MTR.
Okay, that's the core concept right there.
It is. That's the anchor. Deductions leverage the highest rate you pay, not your average rate, not some blended rate, the highest one.
So this lets us move past that, that feeling of I'm being taxed a lot.
Right.
And into the actual mathematics of tax planning. So if someone's income pushes them into the highest possible tax bracket, their MTR could be, what, over 50% in some provinces?
Oh, easily. In some places, it's pushing 54%.
Wow.
So let's use that number. Imagine a high-income earner. They're thinking about a $20,000 RRSP deduction. If they're just thinking about their average tax rate, which might look, kind of comfortable at 35%.
Right, they'd calculate their savings based on that.
They would. They'd estimate the tax savings at $7,000, 35% of 20 grand.
But that's wrong.
Completely wrong. If their MTR is actually 54%, that deduction is saving them $10,800.
That's a $3,800 difference.
It is, and that difference is purely the result of misidentifying the correct rate of leverage. It's not theoretical, it's real cash. It's the tax refund they get back.
A mistake in finding your MTR leads directly to a huge miscalculation of the benefit of what you're doing.
And we can take that a step further. When we talk about this leverage, we're also talking about something called the tax shield.
The tax shield. Unpack that.
Any expense that's deductible, like an RRSP contribution or, as we'll see later, childcare costs, is protected by this shield. The government is, in effect, subsidizing that expense at your marginal rate.
So if my MTR is 50%?
The government is basically paying for half of that deductible expense through the tax savings they give you. It's a powerful concept to grasp.
Okay, so that's the MTR, the strategic rate. Now let's contrast that with the average rate, or the effective rate. This is the number most people quote, right?
It is. It's the one people talk about at dinner parties.
Yeah.
And the definition is really simple. It's just your total income tax paid divided by your total taxable income for the year.
So it's a backward-looking number.
Precisely. It gives you a historical picture. It answers the question, on average, what slice of my income pie did I give to the government last year?
And since Canada has a progressive tax system, these tiers or brackets where the first dollars are taxed at lower rates, there's a fundamental structural rule about how these two rates relate to each other.
There is. And the rule is simple. In any progressive tax system, your average tax rate will always be lower than your marginal tax rate.
Always.
Always. Provided you've earned enough to get into at least the second tax bracket.
Why is that?
Because that average calculation gets pulled down by all those initial dollars that were taxed at the very lowest rates. The federal government's first bracket is, what, 15%? So even if your last dollar is getting taxed at 48%, the average includes all that income that was only taxed at 15.
So that pulls the whole average down.
Significantly.
Right.
And that difference is crucial for clarity. If the two rates were the same, that would mean we have a flat tax. Every dollar taxed the same. But we don't.
Right. We have tiers.
We have tiers. So the average rate is a historical benchmark. It's useful for some things, but for forecasting the benefit of a future decision, it's effectively useless.
So what's the use case for the average rate then? In a sophisticated analysis, when would you use it?
You might use it to, say, benchmark Canada's overall tax burden against other countries, or for an economist to calculate the total economic load on households. But for tactical, forward-looking financial decisions, the what should I do next question,
You have to throw it out.
you have to jettison the average rate entirely and anchor everything on the MTR.
You know, understanding this really feels like the essential leap into real financial literacy.
It is.
It's the moment you stop seeing tax as this one big lump sum and you start seeing it as a structured system, a system of tiers that you can actually navigate.
Exactly. You can strategically navigate it using deductions to, in effect, peel off the most expensive layers of your income first.
So it lets you become an active manager of your own taxable income.
That's the goal. Ensuring that every adjustment you make, whether it's deferring income or claiming a deduction, is calculated against that one critical number, your highest marginal rate.
All right, let's shift gears. We're moving from the conceptual rigor of tax rates to the calculation discipline you need for investment profits, specifically capital gains.
Right, and this section of the source material is really clear that while the tax treatment for capital gains is great, the calculation underneath it has to be absolutely meticulous.
This is where record keeping becomes critical.
It is. Capital gains are where your shoebox of receipts meets tax law. If you own an asset for 10, 20 years, every single transaction, every fee, every improvement needs to be documented.
Because if it's not,
You risk totally misreporting your profit years down the road. The potential for error is huge, and the consequences of getting your cost base wrong are, well, they're significant.
okay, so let's break down the basic formula first. It's the skeleton of the whole thing. Capital gain equals net proceeds of disposition minus the adjusted cost base, or ACB.
That's the formula. And once you have that growth capital gain number, then the big tax advantage kicks in,
The inclusion rate.
the inclusion rate. Only 50% of that calculated gain is actually taxable. The other half is completely tax-free.
And that 50% portion that gets added to your income, that's called the taxable capital gain.
Correct. So if you have a $100,000 profit on an investment sale, only $50,000 actually gets added to your income for the year.
And then that $50,000 is taxed at your marginal tax rate.
Exactly. Which means the effective tax rate you're paying on the full $100,000 profit is just half of your MTR.
So if your MTR is, say, 50%, your effective rate on that capital gain is only 25%.
Precisely. And that hugely favorable treatment is why so much long-term passive investing is done in non-registered accounts. You're trying to maximize capital gains over, say, interest income, which is 100% taxable.
But the integrity of that whole benefit, it all hinges on getting the original gain calculation right.
Which brings us back to the main challenge. properly defining and calculating the ACB.
So the adjusted cost base, it's way more than just a price tag when you bought it.
Oh, much more. It's designed to track the total economic investment you've made in that asset over its entire life.
So what are the key things that have to be included? The things that raise your cost base and therefore reduce your eventual taxable gain.
The sources lay out 3 really strict categories of inclusions, and the goal of all of them is to make sure you're only taxed on your real profit after you've recovered all your necessary costs.
Okay, so the first one is the obvious one, the original purchase price.
Right. Number 1 is the purchase price. Number 2 is what we call acquisition costs.
Acquisition costs.
These are the direct, necessary expenses you had to pay just to get ownership. So for real estate, that's your legal fees, land transfer tax, appraisal costs.
And for stocks?
For stocks or other securities, it would be the brokerage commissions you paid when you bought them. These costs are just fundamentally tied to getting the asset, so they have to be added to your cost base.
So if I buy a stock for $10,000 and I pay $100 in commission, my ACD isn't $10,000, it's $10,100.
Exactly. It seems simple, but it's amazing how often that's overlooked,
Yeah.
especially in real estate deals where you have a dozen different fees on the closing statement.
Okay, so purchase price, acquisition costs. What's the third category?
The third one is critical for physical assets like a rental property. It's capital improvements.
And this is where the precision really comes in, I'd imagine.
It is. These are expenditures that add lasting value to the property, or they substantially prolong its useful life, or they fundamentally change what the asset is.
Give me some examples.
So, putting in a brand new heating system, building an extension onto a house, a major permanent structural upgrade, these are all capital improvements.
And this is where the source material draws a very hard line, because it explicitly states what the ACB does not include.
Correct. You have to separate a permanent improvement from just routine upkeep.
So what's excluded?
The ACB explicitly excludes ongoing repairs, routine maintenance, or general operating costs. If you repaint a room, you fix a leaky faucet, you change the furnace filter, those are all just expenses to maintain the asset's current state.
They're not creating new value.
They're not creating new enduring value, they're routine expenses, so they can't be capitalized into the ACB.
Let's dig into that distinction because you can see this being a major audit risk area. Why is a full kitchen renovation usually an improvement, but, say, repairing a broken cabinet door is not?
Well, a full renovation fundamentally changes the economic profile of the property. It usually extends its useful life and increases its market value substantially. Repairing a drawer just restores the property back to the condition it was already in.
So it's about restoring versus enhancing.
That's the perfect way to phrase it. The tax system is enforcing an economic reality here. Only spending that creates new, lasting value gets added to the cost base. If you mistakenly include 10 years of cleaning fees and minor repairs in your ACB, you are illegally and artificially suppressing your capital gain.
And the audit risk question is what?
The audit question is always, was this expense structural? Was it long-lasting? Did it add real value? Or was it just temporary maintenance? That's the line.
Okay, so we have our meticulously calculated ACB. Now we need the other side of the equation, the net proceeds of disposition.
Right. And this is the mirror image of the acquisition costs. It's the gross amount you received from the sale minus any costs directly related to making that sale happen.
So just like acquisition costs increase the cost base.
Selling costs have to decrease the proceeds you received.
For example, I sell an investment property for $750,000, but I pay $35,000 in realtor commissions and legal fees to get the deal done. My net proceeds are not $750,000.
Correct. Your net proceeds of disposition are $715,000.
And that's the calculation discipline the sources talk about.
It is. The precision mandate here is this strict practice of netting costs on both sides. Net the costs on the way in and net the costs on the way out. Only then can you calculate the true gross capital gain.
And that ensures the gain number is really just the pure profit you made, separate from all the transaction friction.
Exactly. And the final link is so important. You take that carefully calculated gross capital gain, you cut it in half, and that 50% figure is what gets added to your income.
Where it's taxed at your marginal tax rate.
It all comes full circle back to the MTR. But the whole process starts with flawless record keeping on your ACB.
Which really highlights the importance of documentation.
It's everything. You're expected to hold on to receipts, invoices, closing statements for every single transaction related to that asset. And you might have to hold them for decades.
If you don't have that paper trail?
The CRA can, and sometimes will, just deem your ACB to be zero, which means you're taxed on the full sale price, a disastrous outcome.
Okay, let's pivot now to a conceptual trap that I think catches a lot of people who are just used to thinking on a simple cash basis.
Hmm.
The timing of when you recognize income, specifically for interest income. This one feels very counterintuitive.
It is, and that's exactly why it gets tested so consistently. Most of us live in a cash basis world. Income is real when the money is in your bank account.
Yeah.
But the tax system, especially for investment income like interest, it often works on what's called an accrual basis. And the conflict between those two views is where the trap lies.
Okay, so let's get the rule down first. The accrual rule for interest.
The core principle is that interest income is taxed on an accrual basis. It has to be included in your income as it is earned, and that's regardless of when the cash is actually paid or received.
Regardless of cash.
And this principle is applied annually, every single year.
Okay, the materials use a classic example here that really illustrates this timing mismatch. Let's walk through it.
Sure.
So let's say on January 1st, 2024, you lend someone money. It's a 3-year loan. And the deal is that all the interest earned over those 3 years will be paid to you in one big lump sum with the principal on December 31st, 2026.
Okay, a common enough structure.
So under the accrual rule, what happens in 2024?
In 2024, the interest that was earned during that year must be declared as income and taxed on your 2024 tax return,
Even though I haven't received a penny.
even though you have zero cash flow from this investment. Then the interest you earn in 2025 is taxed in 2025, and so on. Even though you don't get the money until the very end of 2026, you have a tax liability every single year.
Wait a second, so I have to pay tax on income that I haven't received and I can't even use?
Yes.
That seems like it could create a real cash flow problem for somebody.
It absolutely can. And that natural reaction, the wait until the cash arrives tendency, is precisely why the sources call it a classic exam trap.
So the rule forces you to prioritize the legal accrual of the debt over your own personal cash situation.
It does. The interest is legally owed to you. It was economically generated in that period, and therefore it must be taxed in that period.
How does the CRA even enforce this? I mean, you might not get a T-FI slip, the form that reports investment income, until the loan is finally paid out in 2026.
Well, the legal onus is on you, the taxpayer, to declare the income. You are legally expected to calculate the interest that has accrued each year, even if no payment was made.
So I have to do the math myself.
You do. Now, for more formal things, like a GIC from a bank or a term deposit, the financial institution will handle this. They'll issue a T5 annually showing the accrued interest, even if the GIC doesn't mature for 5 years. The rule is basically that you can't control when you recognize income just by changing the payment date.
Okay, let's talk about the why here, the legislative rationale. If this rule creates a cash flow burden, there must be a very good reason for it.
Boy, there is. The rationale is everything. It's an anti-avoidance rule. It's designed to prevent widespread manipulation of income and tax deferral.
How so?
Without the accrual rule, any taxpayer could just structure loans or other debt instruments to indefinitely delay receiving interest. They could just keep pushing the income into future years.
Like years where they plan to have low income or when they're retired.
Exactly. Or even shift the income across generations or to different tax jurisdictions. It would be chaos.
So if the income has been economically generated, meaning the borrower has had use of the money and owes the interest for that time, the tax system says we recognize that income now, regardless of the convenience of the payment schedule.
That's the core economic principle. It enforces something called income matching. It matches the tax liability to the period when the income was actually generated. If we didn't have this, every sophisticated taxpayer would just use these long-term, non-cash flowing debt deals to arbitrarily defer their taxes for years, and that would undermine the entire annual tax filing system.
And this also highlights a key distinction between different types of investment income. For capital gains, it's all about the disposition, the sale.
A discrete event.
For dividends, it's generally when the cash is received. But for interest, the rules are fundamentally different, and they enforce this idea of time-based earning.
That's right. So the compliance anchor here is simple, but it's absolute. When you're dealing with interest, you always have to think accrual. Defaulting to the cash-in-hand principle is a major pitfall for any income type, but for interest, it's guaranteed to be wrong.
The lesson is clear then. If you earn the interest in 2024, you have to report it in 2024, even if the cash doesn't show up until 2027. Okay, moving on to personal deductions. Let's look at childcare expenses. And here, we need precision not just on who gets to claim it, but also on the mechanical type of tax relief it offers.
Yes, and this leverages our earlier conversation about the marginal tax rate perfectly.
This section seems to force you to distinguish really clearly between the two main ways the government gives tax relief: deductions and credits.
It does. And if you get the answer wrong, you're going to do a fundamentally different calculation of the tax savings.
All right, so let's be clear. The source material says child care expenses are treated as an income deduction, not a tax credit.
That's the first critical piece of clarity. It is a deduction.
So what's the financial impact of that? Why does that distinction matter so much?
It all goes back to the MTR. Because it's a deduction, it reduces the total amount of income that you're subject to tax on. And that means the tax savings are calculated at your marginal tax rate.
Okay, let's really nail down that mechanical difference with an example. Let's say a family has $10,000 in eligible childcare costs. If this were a tax credit, what would happen?
If it were a credit, the benefit would likely be calculated at a standardized lower rate, say the lowest federal rate of 15%.
Okay.
So that would result in a tax reduction of $1,500. And that would be the same for everyone, regardless of their income level.
But it's not a credit, it's a deduction.
Because it's a deduction, the benefit is calculated at their specific MTR. So if the spouse claiming it is in a 40% MTR bracket, that $10,000 deduction saves the family $4,000 in tax.
And if they're in a 50% bracket?
It saves them $5,000. So the structure means the financial relief is what we call high leverage. It's inherently more valuable to higher income earners because the deduction is knocking off their most expensive layers of income.
Right. And that high leverage aspect makes the next rule, the rule about who can claim it, even more important.
It does. Because the rule for who gets to claim it is basically designed to control how much tax arbitrage a couple can get from this deduction.
So what's the key administrative rule here?
The rule that's emphasized in the sources, the one you need to know cold, is that generally the deduction must be claimed by the lower income spouse.
Okay, now that feels counterintuitive again. If the deduction saves more tax at a higher MTR, why would the government force it onto the lower income spouse, who by definition has a lower MTR?
It's another clear case of the government regulating the potential for tax manipulation inside a family unit.
How so?
If the higher income spouse, who might be in a 54% bracket, could claim the deduction, the tax savings would be maximized for the family. By forcing it onto the lower income spouse, who might only be in a 30% bracket, the overall tax savings for the family are deliberately limited.
So it stops the couple from getting the absolute maximum MPR benefit. It aligns the benefit more with the government's policy goals and less with the taxpayer's optimization strategy.
That's the idea. However, the word generally in that rule is absolutely crucial, because this is where the expert knowledge comes in. There are specific, common exceptions where the higher income spouse is actually allowed to claim it.
Okay, and knowing these exceptions is critical for real-world advice.
Absolutely. The exceptions cover cases where the lower income spouse is essentially prevented from providing care or managing the household for part of the year.
So what are the most common ones?
The ones that are tested most frequently involve the lower income spouse being a full-time student, or being confined to a hospital or institution for at least 2 weeks, or being separated from the family unit for a period.
Okay, so the logic is that if the lower income spouse is genuinely unable to use the deduction against their own income because they're in school or in the hospital, then the higher income spouse is allowed to step in and claim it.
Precisely. The system recognizes it wouldn't be fair otherwise. If they're a full-time student, their income might be temporarily zero, making the deduction worthless to them. The rules permit the higher earner to access the benefit in those cases.
So the precision mandate here is that you need to know two things. First, it's a deduction, not a credit.
Right.
And second, it's the lower income spouse who claims it, unless one of these key exceptions applies.
That's a complete picture. And we should also note, finally, that the deduction isn't unlimited. It's subject to specific annual maximums for each child, based on their age and whether they qualify for the disability tax credit.
Right, which ensures the deduction is aligned with actual costs and isn't used excessively.
Yeah.
All right, let's move to what is probably the most foundational tool for tax deferral in Canada: the Registered Retirement Savings Plan, the RRSP. And the distinction we're about to dig into, separating the act of contributing from the decision to deduct, is just fundamental to any kind of strategic long-term tax planning.
It really is. I think a lot of investors get the basics of an RSP. You put money in, you get a tax break, you watch it grow tax-free.
Sure.
But the sophisticated planner understands that an RRSP is at its core a tax deferral mechanism. The tax is only postponed, it's not eliminated. And the real strategic play isn't just about putting the money in. It's about timing the deduction to get the absolute maximum leverage.
Okay, so let's start with the basic function. The contribution is deductible, which immediately reduces your current taxable income and your MTR.
Right. And then years, maybe decades later, when you take the funds out in retirement, they are 100% taxable as ordinary income.
So the whole strategy really hinges on one key assumption about your life.
It does. The core planning assumption is that your tax bracket, your MTR, will be lower when you're retired than it is during your peak earning years when you made the contribution.
So if my MTR is 50% today, and I expect it to be 25% in retirement,
You have successfully monetized a 25% tax differential. And on top of that, you've gotten decades of tax-free compounding growth. That's the home run scenario.
but what if you expect your retirement income to be really high, maybe even higher than your peak earning years?
Then the tax deferral benefit is neutralized. Or it could even work against you. The RRSP's primary value in that case just reverts to the tax-free compounding alone, which is why you have to project your future retirement income before you just blindly maximize your contributions.
Okay, before we can even talk about the deduction, let's define the space where the money goes, the contribution room.
Right. You have to earn the room. It's not unlimited.
So how is that capacity calculated?
Your new contribution room is calculated based on a percentage of your earned income from the previous year. And that's subject to a maximum dollar limit that the CRA sets every year.
And earned income is a specific definition.
It is. It includes things like your salary, net business income, net rental income. But crucially, it does not include things like capital gains or interest income from your investments.
So your ability to contribute is directly tied to you working or running a business. It's linked to economic participation.
That's the idea. And any unused contribution room from past years generally just carries forward indefinitely, which allows people to catch up later in life if they need to.
Okay, now we get to the moment of maximum conceptual clarity, as the sources call it, the crucial distinction. Contribution is not the same as deduction.
Yes. This is constantly tested because it separates casual saving from smart strategy. They are two totally separate decisions.
So what's the rule? Precisely.
The rule is that you can make a contribution in the current year, filling up whatever room you've earned, but the deduction for that contribution does not have to be taken in the current year. You can carry it forward indefinitely and use it in any future tax year you choose.
Okay, so why would anyone do that? Why would you contribute today but purposely delay taking the immediate tax break?
The answer is 100% rooted in MTR optimization.
Okay, give me a scenario.
Imagine a young professional. She's currently earning $70,000 a year, which puts her in, say, a 30% MTR bracket. She makes a $5,000 contribution.
If she deducts it now, she saves $1,500.
Right, 30% of $5,000. But she's also on a career track for a senior role. And in 3 years, she expects her income to be over $150,000, which will push her into a 45% MTR bracket.
Ah, okay. I see where this is going.
If she just holds on to that $5,000 deduction until that higher income year, the deduction is suddenly worth $2,250.
So she gets an extra $750 in tax savings, purely from strategic timing.
Exactly. She gets the immediate benefit of the tax-free compounding, which starts the day she contributes. But she unlocks the maximum tax leverage from the deduction only when her income dictates it's the right time.
So the timing of the contribution is about liquidity and starting the compounding.
And the timing of the deduction is driven solely by tax strategy and MTR leverage.
That really elevates the deduction decision. It's not an automatic thing you do every year. It's a long-term strategic asset.
It is. You are constantly comparing your current MTR against what you project your future MTR to be. And you're using that deduction carry forward as a tool to arbitrage the highest possible tax differential over your entire career.
And how does this work administratively on the tax form?
It requires discipline. When you file your return, you report the contribution you made this year. But then you specifically choose not to claim the deduction for that amount. You indicate that the amount will be carried forward.
And the CRA tracks that for you.
Yes, the CRA tracks this unused deduction pool on a separate schedule on your notice of assessment, ensuring that benefit is preserved for you to use in the future.
Right, so even with the most careful planning, people make mistakes. They might miscalculate their earned income or forget about a pension adjustment and overcontribute to their RRSP.
It happens all the time.
So the Canadian system has this safety valve built in to protect you from immediate, harsh penalties for these minor slip-ups.
It does. But that safety valve is governed by some very precise rules that you absolutely have to understand.
We're focusing here on the threshold that's designed to prevent penalties for small, accidental overcontributions. A bit of leniency from the government?
A little bit, but it comes with strict limitations on the tax benefit side.
Okay, so let's talk about the $2,000 lifetime buffer. What is the exact mechanism here?
The rule is that there is a lifetime buffer of $2,000 above your calculated contribution room where no penalty applies.
And let's be clear, this isn't an annual buffer.
No, absolutely not. It's a one-time allowance across your entire lifetime. So if you have $15,000 of RRST room, you can contribute up to $17,000 without triggering the penalty.
And this exists just because, these calculations can get complicated and the government doesn't want to hammer people for honest small mistakes.
That's the spirit of the rule. It prevents a catastrophic penalty for a minor overshoot. But, and this is the critical limitation that ties back to our last section, even if you are inside this $2,000 buffer, no deduction is allowed for that excess amount until you earn new contribution room in a future year.
Okay, so the buffer is purely a compliance measure. It just stops the penalty. It doesn't change the rule that deductions are only allowed against actual earned contribution room.
That's it perfectly. You've basically just tied up $2,000 of non-deductible after-tax money inside your RSP.
So that money will still grow tax deferred.
It will, but you get zero upfront tax benefit for it. You're protected from the fine, but you've still made a suboptimal move by effectively parking after-tax money in the plan.
And that distinction, preventing a penalty versus granting a tax benefit, is a core conceptual point of this material.
A huge one.
So if a person over-contributes by, say, $1,500, no penalty applies. They just have to wait until next year when they earn new room.
And that $1,500 will be absorbed by the new room, and only then does it become eligible to be deducted.
Right. So the buffer gives you some breathing room to fix the error without fines. But what if the overcontribution is big?
If it's a large amount, just waiting for future room might not be the best strategy, and that's what leads us into the penalty zone.
So when does the full punitive penalty system actually kick in?
The penalty only applies to the amount you've contributed that is above that $2,000 lifetime buffer. Any dollar over that threshold is subject to a really severe deterrent.
And the rate is designed to be exceptionally high.
It is. The government sees this as a serious abuse of the registered system. The penalty is defined as 1% per month on the excess amount over the $2,000 buffer.
1% per month, not per year.
Per month. That frequency is the absolute minimum level of detail you need to know. It's not some theoretical annual fine. It accrues every 30 days.
Okay, let's calculate that. If someone accidentally overcontributes by $10,000, the amount subject to the penalty is $8,000. That's the $10,000 minus the $2,000 buffer.
Correct.
So if they don't fix this for a whole year, the penalty is $8,000 times 1% times 12 months.
Which is $960.
And that's a $960 penalty on top of the fact that the entire $10,000 contribution was non-deductible in the first place.
Exactly. It creates this huge financial incentive to correct the mistake immediately. If you let it ride, the effective annualized penalty rate is 12%, which is just brutally punitive.
And this is why advisors need to understand the correction process. You have to file a special form, the T1OVP.
Right, the specialized return for reporting the excess contributions. And then you have a choice. You either withdraw the excess funds right away, or you wait for new room to absorb it, depending on how big the problem is.
So the key takeaway here is, if you realize you've overcontributed, that first $2,000 buys you some time without a penalty.
But anything above that, you have a clock ticking. A 1% per month clock that is ticking relentlessly against you.
Wow. That was an incredibly detailed and I'd say demanding deep dive into the core principles of Canadian tax precision.
It was dense material.
We've really established the conceptual frameworks you need to move past just general knowledge and into real strategic application.
So let's lock down those core anchors one more time, the things that really separate the novice from the strategic planner.
Okay, let's do a quick recap. First, we established the absolute supremacy of the marginal tax rate.
The MTR is the only rate that matters for any forward-looking planning. It dictates the true value of any deduction.
While the average rate is just a historical benchmark.
A benchmark, nothing more.
Second, we reviewed the need for absolute calculation discipline, especially with the adjusted cost base.
Right. Remember the formula. ACB is your purchase price plus your acquisition costs plus only your structural capital improvements. Never routine maintenance.
Third, the critical importance of timing, especially that accrual rule for interest income.
Which is really an anti-avoidance rule that forces income to be taxed as it's earned, regardless of when you get the cash.
And finally, the big strategic lever for RSPs, separating the contribution decision from the deduction decision.
Contribute now to get that tax-free compounding started, but strategically hold that deduction until a future year where your MTR is projected to be at its peak.
You know, the ultimate guiding principle from all this source material seems to be that the tax system is just unforgiving of conceptual sloppiness.
It is. The big audit issues, the complex financial questions, they punish imprecision, not ignorance. Mastery means you have to know the details.
The 50% inclusion rate, the $2,000 lifetime buffer, the 1% per month penalty.
You need to know them with unwavering exactness.
And that leads us to our final thought for you, the listener, to take away from all this.
Given the power of the marginal tax rate and given your ability to defer an RRSP deduction indefinitely, consider the compounding strategic value of that.
Well,
If you invest early, say in your 20s, but you defer the deduction for 20 years to align it perfectly with your absolute peak earning bracket in your 40s, how much of your total retirement wealth, mathematically speaking, comes from the decades of tax-free growth?
versus the immense boost that you get purely from that MTR arbitrage on the deferred deduction.
It's a fascinating question. The strategy isn't just about saving tax this year, it's about using the timing rules to arbitrage the difference between your lowest and your highest marginal rates over a 40-year career.
It really confirms that the contribution is a tactical move.
But timing the deduction is the master strategy.
Thank you for joining us for this rigorous deep dive into Canadian tax precision.
A pleasure as always.
We really hope this equips you to approach your own financial decisions with a renewed level of conceptual clarity and rigor. We'll see you next time.